Sometimes that 30-second countdown feels like an eternity. Today, it felt a little longer than normal. Hey, welcome back. Maybe I'm still on that. Is it tryptophan from that you get from turkey, and it kind of gives you that quiet, kind of sleepy feeling. Maybe that's it. But hey, welcome. My name is Jeff Harrison, and this is Mortgage Minute with Art Alvarez. And I was going to say something like, speaking of turkeys, let's see if Art is available. But that would be right, because he is absolutely, it's one of those things. There's eagles and there's turkeys. He's definitely an eagle. Let's see if the eagle has landed. Welcome back. Hey, Art, how you doing?
Hi, Jeff. How are you?
Good. Yeah. All of a sudden, I realized, wait a second, that's both feet in the mud. I shouldn't do that.
Yeah, and I think now that it's Thursday, I think I'm finally over the tryptophan from the previous week. So
is that what it is, tryptophan?
Or whatever it's called. I think you're right. I'm not sure. I'll have to Google that.
I think that's why, for most of the men, during football, we fall asleep in the second half. It's because we've had that turkey sandwich in the afternoon, right?
That's right. Yep.
Yeah.
Been there,
So did you have a nice Thanksgiving?
I did. Yeah, it was really nice. How about you? Good?
Yeah, it was good. It was good. No, it's one of those things that we have no children. And so what we do is a lot of times we'll do what we call a friends Thanksgiving. So we'll kind of invite orphans over, not orphans, but, people that maybe their kids are out of town or they've gone away or whatnot. So it's a nice little get together. And my wife does not like making the traditional turkey, so she'll always have something, crazy, that not crazy, but something special cooked up. And it's always a nice surprise for people that first come over and they see surprise on the face that there's no turkey and stuffing.
Ah, okay.
So
we do a little bit of both. We drop a turkey, and then we also do paella usually. So.
Oh, nice.
Yeah,
so the paella. Now, why paella? What's the connection there?
Well, that's the classic Spanish dish, and of course, given my last name, although my last name is from my grandfather from Michoacan, Mexico, but my paternal grandmother, was from Spain, and so growing up, paella was an important part of our meals. So.
Somebody asked me about that, and it's really kind of comes from the standpoint of something I want to show before we get going. And one of our staff members says, I did these for Art, and his name says Alvarez, but he doesn't look Hispanic. I said, no, he doesn't. So you just cleared that up. So I'll have to share this with her and let her know this is how Art Alvarez came about. So I want to show this video, and then we'll come back and talk about it.
Okay.
What's new in the world of home loan interest rates for home buyers today in California? The good news is the Fed Chair, Jerome Powell, has temporarily paused the rate hike in his last meeting. The news came as a sign we may possibly have seen the last of these hikes. As I say, this can be interpreted as good news for home buyers. The 10-year Treasury note, which truly is a barometer of the interest rates being offered to home buyers, has dropped. As you look at the graph, we can see that in the past 5 days, while there has been a bit uptick here and there, overall, the rate has fallen. As of this message, the 10-year Treasury note is at 4.636% and is down off today's high. So what does this mean for the home buyer when it comes to an actual rate? In this second graph from the MortgageWorks website shows the latest rates being offered. We can see that these have also dropped off the highs we saw just a couple of weeks ago. I want to also point out, looking at the bottom of the rate chart, the home equity line of credit rates continue to be stable. This again is good news, as the cost of home equity line of credit loans will hopefully continue in the same downward trend. Thanks again for joining me on Mortgage Watch. I am Art Alvarez, also known as the home of the 1% broker fee, meaning no matter what size your loan is, the broker fee is only 1%. The savings to you can be tremendous. If you would like more information, I am always available at 760-883-5700. I will be back tomorrow for Mortgage Watch. Have a great Monday.
So Art, that's something new. Tell us about that.
Yes, it's basically a new pricing strategy that we're going to be undertaking here going forward and into 2024. And for the sake of our viewers, as you know, we typically start off by talking about where mortgage rates are and what's causing rates to be where they're at. And we do that by talking about the 10-year bond yield, which I continue to say is the best barometer to track mortgage rates. And we also post our rate grid. And so that video that you just watched basically summarizes what we're going to be doing going forward and how we price our loans. And we're going to post our rates on a daily basis on platforms such as Facebook and YouTube. And, as it relates to our rate grid, one of the things I want to remind our viewers, particularly anybody who's new to watching this program, is when you go to our rate grid, which is on the homepage of our website, you want to take a look at that about mortgage rates link at the bottom right in the red box. And the importance of that is because I go into some detail to explain how a particular mortgage rate is going to be offered to the buyer or the borrower. It's going to involve, of course, where bond yields are at. That's part of it. And it's also going to discuss various what we call risk factors, because mortgages these days are essentially mortgage rates are determined by what we call risk-based pricing. So that means that different criteria of your transaction is going to be taken into account to establish what rate you're going to get. Factors like what your credit score is, what your down payment amount is, what kind of property type you're purchasing. All of those things and others will affect what kind of rate you're going to get. And one of the things I've noted in past programs of ours, when we're opening with the market update, I'll oftentimes make reference to the fact that, when I get up early in the morning, I'm usually getting on the financial news, turning on the TV and seeing what's going on with the markets. And of course, a good source of that, if I'm plugging a particular channel, is CNBC. And one of the things I've always found, and I've mentioned on the show many times, when I see CNBC posting the average mortgage rate available on that particular day, it's always higher than what we have posted on our website for that day. Well, why is that? Well, of course, again, you go to about mortgage rates to find out some of the factors involved in how your rate is set. But the other thing about it, I think, is our lender paid compensation. I think that is the difference maker in terms of why our rates are oftentimes much better than what you see on the news, whether it's CNBC or some other news platform, or if you're reading an article. In fact, I read a couple of articles this morning on the finance pages referencing the average mortgage rate right now at 7.41. And what's interesting is that's a little bit on the high side compared to where we're at. And our focus now is we've always had pretty low lender paid comp. What that means is with every lender that we're set up with, we have to declare in advance, no more frequently than quarterly, what we want to get paid for every loan that we deliver to a lender. That's a regulatory scheme that's been in place since April of 2011. And so what that means is that when we declare it, we have to declare our lender paid comp based on a grid that runs anywhere from usually a minimum of 1% of the loan amount up to 2.75% of the loan amount. Many of the lenders I do business with will tell me that their average broker has their lender paid comp declared at somewhere close to 2 or even a little over 2%. We at MortgageWorks have always historically been below that. Usually we started off at 1.5%. Several years ago, we were at 1 3/8% of the loan amount. More recently, in the last 4 or 5 years, we've been at 1 1/4% of the loan amount. But I decided that given it's not that difficult to package a loan, and whether it's a $200,000 loan or a $2 million loan, the amount of paper we put in that file to get it from application to closing is going to be more or less about the same, plus or minus. And so it occurred to me that we can make a decent living in our business. We can run our business profitably without having to charge that very high percentage of loan amount for our comp. So I've decided going into 24, and given that rates are high anyway, and we have some borrower resistance to rates, I want to put forth the best rates possible while at the same time giving the borrower the added element of our experience and expertise. So that's why going forward, we're going to post a Mortgage Watch video daily on platforms like Facebook, like YouTube, where we're going to display our rate grid and remind everyone that we are going to be your low-cost provider of a mortgage with our 1% lender paid comp broker fee. What that means to you is you're on average going to get an interest rate that's probably going to be anywhere from 1/4 to 0.5% compared to other brokers who offer or who require a much higher lender paid comp than we do. So I wanted to just cover that so that you're understanding as we go into future programs and you see our rate grid and you hear news stories where the rates seem to be higher than what we're posting. That's a big reason why we're willing to originate that loan for you to give you the best rate possible and do so at what we think is a reasonable compensation, but at the same time, a compensation amount that's going to get you the best rate. Okay, Jeff, with that, I want to go back to you because I understand we have a couple of questions this week from our viewers.
Yeah, I think that's pretty exciting. I don't want to let you off the hook quite that easily because that's a big thing. When you talk about the rates being charged, and I think from, let's say, the home buyer experience, that seems to be the most confusing part. As you said, I can watch the news in the morning. It says it's 7.4. I look at your rate chart. It says 7, even under 7% for a 30-year, and all of a sudden I'm confused. Like, well, why is that? Is it because I live in, our brain starts figuring this, like, is it because I'm living in a different part of the country? What is it? And it's interesting how it all circles around that whole lender based compensation to the brokers.
Well, exactly right. And one of the things I try to encourage people is, part of the reason we're doing this is that, there's a certain segment of the market out there of prospective borrowers. They're rate shoppers. They'll check multiple lenders to try to get the best rate possible. Our strategy is really being implemented to address that. I want rate shoppers to call me, at least ask me for a worksheet. It doesn't take long for me to prepare that. And after all, with most other major purchases, buying a house, buying a car, buying a mattress, I mean, you're going to shop the rate, you're going to shop the price. And there's a certain segment of home buyers, of home borrowers who do that. And I think I would encourage more to, and just consider us when you're doing that rate shopping. The other thing that we're trying to address is there's borrowers who really like online lenders because they think just because they're online, they're more efficient, they're going to give you a better deal. That actually is not true to a pretty good extent. I can usually meet or beat most online lenders. And the other thing that our pricing strategy, I think, is really going to be helpful with is those jumbo borrowers. If you're getting a loan for $1 million or $1.5 million or $2 million, I mean, for example, a $2 million loan, well, part of our 1% lender paid broker fee that we're now going to be doing is we're going to put a cap on the maximum amount that results from that formula at $7,500.
Wow.
So if you're getting a $2 million loan, I'm going to be arranging that loan for you for less than 0.5% of your loan amount as to what we're compensated. That should make a big difference to you in the rate if you're a jumbo loan borrower. So that's the kind of thing we're trying to address.
Now let me ask you a question. So just to clarify, check my math here. So if it's a $2 million loan and my broker compensation fee is 2%, that's $40,000.
Correct.
Is that correct? And yours is
correct.
Capped at what again?
7,500.
Okay, so I'm just looking at that's like $32,500 in savings. I mean, I think about that. What can you do with $32,500 in savings if you're just buying a new home? That could pay for some of the appliances,
Well, exactly
whatever.
Right, because the way that money gets accessed when you're comparing us to that other broker who wants 2% of the loan amount on their lender paid comp, that money oftentimes squirts out in a much better rate, which means a much lower monthly payment, which will help you pay for those other things that you need for your home. So that's really part of the reason we're doing this is we want to put some more focus on, number one, how much we're getting paid. We think you should know when you first do business with us, when you first apply for the loan. I'm a big believer is I want to tell you what we're getting paid and why, and how that's going to benefit you when you get that loan that we're arranging.
For those of you watching this live or, recorded, one of the things that we love in our world anymore is transparency. If you need any information, it's all online. And, here's somebody who's been doing this business for 42 plus years and has arranged thousands and thousands of loans. And he just says, hey, let's just tell you what, let me just show you my cards. It's right up front. There's no trick. This is the way it is. I think that's who you want to deal with. So, I just had to pick at that just a little bit. I could keep going, but I won't because I know you've got a show here. But the questions today evolve around, rent payments and credit scores. And I've heard that reporting your rent payments to the credit bureau can improve credit scores. Is that true? And how does it work?
Well, it is true. It's actually interesting. I think one of the reasons that I think that's a good question, why I wanted to talk about it today, is because it's a program that I don't think has a lot of there's not a lot of market awareness of it. It's actually a program that was kicked off last year by Fannie Mae in September of 22, and it's a pilot program. And the idea is, in fact, let me read it to you here. It's called the Positive Rent Payment Program, or PRP. So since September of 22, what this program allows is that a renter can have their rent payments that they're paying to the property management company or to their landlord reported to the credit bureaus. And that's important because in the past, rent payments have never been reported to the credit bureaus. So in the sense that if you're a renter and you have a very positive rent payment history, that really hasn't been taken into account in the credit scoring models, which of course are an integral part of what determines your rate. So in that sense, you're kind of in an unfair position compared to a homeowner, because the homeowner's mortgage payments are getting counted in by the credit bureaus and included in your score, but not if you're a renter. And some of those rent payments home renters are paying, some of those payments are pretty high. And to be able to record that should make a pretty big difference in your score. So in that sense, it's true that this should make a difference, but I think it's been underutilized. The program just got extended through December of 2024. So renters, anybody out there listening, watching this program right now, if you're a renter, you're not aware of this, heads up, you should check it out. The best thing for you to do is contact your property management company or your landlord, whoever you're making your payments to, find out if they're participating in this Fannie Mae pilot program. If they are, then of course you're going to want to ask them to be sure that they're reporting your payment history, your rent payment history, to the bureaus, because if you're in the position where you're starting to formulate a plan to buy a home in the near to medium future, getting those payments recorded should help with your score. That's going to position you better for qualifying for that mortgage when you're ready to buy.
You know, it's interesting, Art, that this hasn't been something that's been ongoing. It's just something new because, I mean, you've been doing it for 42 years. So if I were a renter, I get no credit for the fact that, hey, okay, I've been on time for the last 5 years at this home that I've rented out or an apartment that I rented out. There's been no credit. Is that correct?
Correct. As to any effect on your score. And in fact, your rent payment history, essentially up until this pilot program, really had the ability to hurt you more than help you. In other words, if you're a renter, in a lot of cases, when we initiate the loan and we go through the automated underwriting system process, we may be required to get a rating on your rent payment history. That's typically done by sending a form called a VOR, a verification of rent form, to your landlord or your property management company. They will fill that out and provide a rating on your rent payments for the last 12 months, if you paid on time or if not, if you've been late, how many times you've been late. So what that information does, if it's all good, all positive, 0 lates, excellent tenant, no effect on your credit score, and therefore no real effect, good or bad, on your rate. But if you have a poor verification of rent from your landlord or property management company, again, it's not going to affect your score directly at all, but it could jeopardize getting approved even based on the score you do have from other credit history, simply because, you're not paying your rent on time. How can we expect you to pay a mortgage payment on time? So I argue that up until now, a verification of rent process really only had the ability to hurt you, not really to help you.
It's kind of one-way street there, wasn't it?
Yes. Yeah. And that's why I think a program like this, which I hope becomes a permanent part of the mortgage arena, I think it will be very helpful, and I think put a more level playing field as it relates to renters and current homeowners.
So now you said this is a pilot program. So not everyone out there, you know, is eligible for that, or is it just a matter of, hey, if I have a multifamily dwelling or something of that nature, or I have apartments, can I apply for that, or do I want to apply for that, or they contact me? How does that work? Do you have any idea?
Well, Yeah, I think the issue there has been that, the property owners have really had no incentive to report payment history to the credit bureaus. So this is really sort of a push of demand by the renters who, now that they know that Fannie Mae has announced this pilot program, those renters are being encouraged, reach out to your property owners, your property management company, if the owner uses that, or the property owner, the landlord directly, and inquire if they're aware of the program. If they're not, the renter should encourage the property owner to check out the Fannie Mae program in more detail, learn what they can do and how to do the reporting to the bureaus. So that's going to, for one, it's going to improve the credit score for that existing tenant, which is going to be some benefit to the landlord. And as well, again, it's going to help them position themselves for better scores to get that mortgage later on.
Well, isn't it true that whenever, and again, I'm not trying to have you put on your credit, company hat, but I'm just curious now, if somebody does go and rent, do they pull a credit to find out what their payment history is before they rent?
Yeah, exactly. And landlords do that. Property management companies do that. So if you're a renter, you're going to have your credit score pulled when you're being evaluated to get that rental property, when you're probably, competing with 10 or 15 or 20 other, applications. So in that sense, getting your property manager to report that information, even if you're not looking to buy a home later and you may have to move and rent somewhere else, it's going to help you on that next rental situation, that next rental agreement, because you'll already have better scores because you have a rental payment history that's been reported to the bureau.
That's fantastic. Well, so I think you said that's a positive rent payment program.
Yeah.
And that's
PRP.
by Fannie Mae.
Fannie Mae.
It's on there if you want to know information about it. If you have any questions, like I said, contact your property manager or landlord, and they'll get that squared away. The next question is a little bit different. It's kind of like, it feels like with rates starting to ease a little bit. I hate to say this because I don't want to jinx this, Art, but with the Fed kind of easing their foot on the we're going to raise the rates again pedal. We're kind of saying, okay, we're starting to see a movement in the market again. So I'm just curious, who's buying a home today in this economy?
Yeah, that's a really interesting question. And I've been reading up a few news stories about that. In fact, I saw one not long ago that, basically was, the headline kind of was in the form of kind of a complaint, that baby boomers were, buying up all the homes and shutting out the younger buyers, the millennials and even the ones before millennials. I can't keep track. Is it Gen Z or, whatever's before millennials. And I think what's interesting is the data to some degree kind of supports that. And so I wanted to address that a little bit. One of the things to know is, like, for example, the average income for a home buyer from July of 22 to June of 23 increased to 107,000. It was 88,000 the year before. So the implication there is it's the more wealthier the more wealthier buyer that is sort of, edging out the lower income borrowers. So yeah, that data would seem to suggest that. But what's interesting is, one of the things I think about is, well, if you were 88,000 average income for a home buyer from July of 21 to June of 22, well, during that period, we were still on the tail end of 3% mortgages. And if you had an $88,000 average income, which, even as we're coming out of the pandemic, I would argue, for example, a lot of millennials probably had income at that level. And if we had 3% mortgages at that time, that 88,000 was really a pretty good amount of borrowing power to buy a home. And yet, if you recall, at the time, there was a lot of news stories that millennials weren't buying homes, and the reason wasn't rates. Rates were very low. I mean, the money it was almost free money, and yet millennials weren't buying then. When in hindsight, you could argue that's when they should be buying, should have been buying, and yet they didn't in large numbers. So that to me is a little bit interesting in that, well, if you're having trouble now, you may have missed your window. If you were making $80,000 or $90,000 in 2021 when rates are 3%. Gee, why the heck did you go out and buy a home then? Because you know what? The other thing is, homes were, while they were rising in price at that time, they were cheaper than they are now because home prices have gone up even more since. So it feels to me like I don't want to offend any millennials out there. A little bit of sour grapes that, you had your chance, you didn't do it for whatever reason. And yeah, now it's a tougher time. So that's one thing I would want to point out. The other thing that the data shows is really kind of interesting. Single women are,
Oh,
there are more single women buyers than single men buyers by almost double.
wow.
Plus the fact that single women are a little bit older, on average are 38 versus the men are 35. So that's, I thought, was a really interesting, and I've seen some of that, thinking back over the last year or two, not something I had focused on before, but I kind of went through our closings and was like, yeah, single woman here, single woman there. So it's sort of evolved into a phenomenon that we didn't see that many years ago. So that's another interesting bit of information. And then the other thing I would tell you, the average age of a first-time home buyer has gone up. It's now about 35. In the
Wow.
1980s, it was about 29. So that's gone up. So people are waiting longer to buy. Then the other thing, repeat home buyers. The age discrepancy there is really pretty surprising. Now the average repeat home buyer is 58 years old. In
Wow.
1981, it was 36.
Oh,
So that does sort of support the idea that, yeah, maybe baby boomers are buying up more of the homes now, probably in part because they got into home ownership a lot earlier, experienced that growth in value, and were able to cash in that equity. And then, of course, they got all that money now, and they're the ones who are buying up a lot of the move up homes, the larger homes, 3-4 bedroom, that kind of thing. Although at some point, keep in mind, those baby boomers are going to turn around. They're going to turn on a dime and suddenly downsize and go to smaller homes. So that's probably in our future, because the baby boomer generation is this big old chunk that's rapidly approaching retirement age. Half of us already are, except for some of us who are still working. But in any event, some interesting data. I think there's some truth to that, but with a grain of salt. But overall, yeah, the age of the average home buyer and borrower has gotten more elevated over past years. So
I think the interesting part about some of that data, and I'm curious if you have just your thoughts on it, with the women buyers over the men buyers and being double, like, what's your thought on that? What any thread there you want to pull on?
hard to say. I mean, it's apparent that in a lot of cases, or in more cases, you're seeing the women are the breadwinner. In
Mm,
fact, I'm in the midst of pre-qualifying somebody right now, where and that's not to diminish the man in the family at all, um, but I've got a transaction in the pre-qual stage now where the wife is the breadwinner. She makes the majority of the income, and we're going to rely on that income predominantly to get the borrowers qualified. And I'm seeing more of that. And again,
hmm.
nothing to diminish the man or that other spouse in that regard. It just seems to be that women, for whatever reason, a lot of times in the family, they're the ones making more money. It's not, traditionally it's always, oh, the man's the breadwinner and the woman's like working, but yeah, not in a lesser paying job or part-time. I would say that there's a lot less of that. You see a
Hmm.
lot more women who are at higher incomes, have a real career, and they really are sort of the breadwinner in the family. I think that's more common.
Inter- Interesting. Well, thanks for diving a little further into that. I think you've got some other things here. Last week's closing question. I'll turn it over to you, and I'll step aside.
Okay, thanks, Jeff. Yeah, to finish up our program, I want to go into our closing question for last week. Jeff just posted it here on the grid here on the slide. The question is, regarding a cash out refinance loan, what is the delayed financing exception? Well, in answering that question, the first thing I thought would be good is to first remind all of you, what are the basic rules for a cash out refinance. And in describing these, I'm going to point out something that's an important and relatively recent change. Number one, if you're pursuing a cash out refi as a homeowner, your existing mortgage must be at least 12 months old. That's a change. That was a change implemented this year. Prior to that, if you're a homeowner, had an existing mortgage, you could get a cash out refinance after 6 months. In other words, if that was a purchase mortgage and you've only owned the home for 6 months, in order to do a cash out, that existing mortgage had to be 6 months old. It's now a year, 12 months. So keep that in mind. That is going to be a deterrence for some homeowners who think that they want to be able to do a cash out, just a few months after purchasing their property. Maybe they put a large down payment and they want to pull some of that back. You got to now wait 12 months for that to happen. The other thing is at least one borrower must be on title for at least 6 months. That actually sounds like it conflicts with the first bullet point. Well, if you can't get a cash out refi until your existing mortgage is 12 months old, well, at least one borrower must be on title for 6 months. Well, obviously that's going to be the case if you've got a 12-month-old mortgage that borrower is on. Your debt to income ratio, when you're getting a cash out refi, if your debt to income ratio is over 45%, it requires that you have 6 months of what we call post-closing reserves. That's money in the bank after closing, checking, savings, stocks, mutual funds, and retirement accounts. You have to have at least 6 months of your monthly housing expense in reserves after you close when you're getting a cash out refi and your debt to income ratio is over 45%. Also, some homeowners think you've had your home listed for sale, it hasn't sold, you got a lot of equity, you want to tap into it. Oh, I'll go get a cash out refi while I'm trying to sell my house. That's a no-no. You can't do that. If you want a cash out refi, you've got to take your home off the market. We have to verify you've canceled your listing. You have to write a letter saying, hey, I'm sorry, I didn't mean it. I'm not going to sell. I want to keep my home. That's why I want to get cash out, because I'm going to keep it and doll it up, or whatever the case may be. So those are the basic rules. So what is delayed financing exception? Well, you can get a delay. You can do a cash out refi pretty much almost immediately after acquiring the home. But the first condition is there can be no mortgage used to acquire the property. That's a kind of a long way of saying you had to buy the home for cash. So again, no mortgage was used to acquire the property. So that means if we start a delayed financing refinance transaction, we're going to verify that when you bought the home, you did not get a mortgage to buy the home. Now, what you can do when you're buying the home for quote unquote cash is you may have gotten your funds from a personal loan, believe it or not, that's allowed, or a HELOC on another property. Or, of course, you may have just pulled cash out of the bank and paid cash for the home. The point of that is we have to source and document when you put all that money into escrow to close the purchase without any mortgage being recorded. We have to document where that money came from. It either has to be money that was seasoned in your bank accounts, or we have to verify that money arrived because you had a personal loan or a HELOC. So we have to get the copies of the loan contracts for that personal loan or for the HELOC, and in order to verify that that's where the money came from. And if that's the case, when you're doing the cash out delayed financing refinance, and you got the money to buy the house from a personal loan or from a HELOC, the proceeds from that cash out refinance have to go back to paying down or paying off that personal loan or that HELOC, with no money coming back to you. So just understand that is a requirement if you're doing a delayed financing cash out refinance. The real purpose of this was to allow home buyers who maybe because they wanted a quick escrow, they didn't have time to go through the loan qualifying process, but they had adequate money in the bank. They just wanted to get the purchase done. Maybe they thought it was going to create a more competitive offer on their part when they're competing with other offers. So they quickly close with cash. That's appealing to sellers. But then after closing, they wanted to do a refi to get some of that cash back, maybe put it back in investment accounts that they had it in before or something of that nature. So that's what delayed financing exception was created for. It's still available. So all of you people who are looking to buy a home cash or may have done so recently, you do have that option to refinance, get your cash back without having to wait 12 months. So with that, that was a good question. I want to go on to our closing question for next week, which I also think is a good one. I'm looking to purchase a home and have substantial liquid assets, but limited monthly income. Will my substantial liquid assets help me qualify despite my limited monthly income? I just was asked this question by a prospective buyer last week. So next week, I'll have the answer to that question for you, and it'll be on the house. Jeff, back to you.
I think that's a great question, and I have to share that in my days gone by, when I was investing in property, I did use that pay cash and then push the equity by rehabbing the house and then immediately putting a mortgage on it. And then, those rules changed over time for investment properties, but this one piqued my interest. Like, okay, what is the answer now in today's environment? So thank you, Art.
You're welcome. Thank you.
All right. So, here's the information for Art to get a hold of him. He's talked about a lot of great things today. If you're a renter and you're thinking, hey, I want to start working on my credit and getting credit for the rent that I'm paying. He talked about a program today, and then also who's buying up houses. Some of those stats are a little misleading, some of the headlines are a little misleading. And he's always taught us, hey, don't fall for those. What's your saying on that? Don't
beware the headlines.
Beware the headlines. That's right. So make sure you read down a couple of paragraphs to start getting some of the details. But anyway, you can get a hold of Art at 760-883-5700. And his cell phone is 714-612-9035. His website is mwloan.com. And of course, you can always email Art at mwloan.com. Now, at the very beginning of the show, he showed a program that he's doing every day. This is 5 days a week. When I say every day, Monday through Friday. And it is a update every day on what's going on with that ever-moving treasury, the 10-year treasury, and also how does it affect the rates. And he's updating his rate grid every day. That comes up at 11:30 Pacific Standard Time. And it's just there as it's no selling. It's just saying, hey, here's what's going on. So you can see that on, platforms like Facebook, YouTube. We're going to be putting it on LinkedIn. We're trying to get him on, Google Business profile, things of that nature. So wherever you're thinking about, hey, what is the rate today? That's where this is going to be playing. So I'm excited to share that. Art, any last words before I pop out of here?
No, I agree. Thank you for mentioning that as to the Mortgage Watch on a daily basis. That way we're going to give people more options to be able to check mortgage rates on a daily basis, whether they go to our website or look at those other platforms. So I'm excited about that. I'm hoping that that'll help people keep informed. And of course, if you're shopping for a mortgage, give us a shot. Be happy to give you some written quotes and see how we come out against the competition.
Yeah. And, one of the things I want to point out too is if you have questions and you weren't here live, please just put them in the comments, whatever platform you're watching on. Art keeps an eye on that. He'll come back and answer it because he is Art Alvarez of MortgageWorks, where he has the answers and they're on the house. With that, Art, I'll say have a great week and we'll see you next week.
Thanks, Jeff. Thank you, everyone. Thank you for watching and listening. Welcome to, thank you for watching this week's Mortgage Minute. Have a good week. I'll see you next week at the same time. My name is Art Alvarez at MortgageWorks, where we do have the answers and they're on the house. So long. Take care.